Thank you for joining me for a very brief look at order types. Now, order types are more important than many investors realize because the right type of order can increase returns by a small amount. This is especially true in less active markets. So, for example, if you're trading illiquid stocks, the right order type could be important. And if you're trading options, the right order type can be important. So the order type can be used to restrict how market makers take advantage of individual investors. The market maker's job is to take advantage of individuals. So they're seeking to maximize their profits. And if we put in the wrong type of order, we give them a little bit extra profit. And on order entry in particular, it's a zero-sum game. So if you put in the wrong type of order, you're going to lose and the market maker is going to win immediately. So that's why it's so important to consider order types. Now there's four basic types of orders. There's a market limit, a stop, and a stop limit. And you're probably familiar with the first three. Market order is filled immediately. Limit order is filled only at a specified price or better. Problem is it may not be filled, especially in a fast-moving market. So you may see a stock trading at $10. You may put in a limit to buy at $10.05. The stock just immediately shoots up and it goes all the way to 11 without ever filling your order. That's the downside of a limit order, but over the long run, over the course of many trades, a limit order is often going to be preferential even though you may not get filled on a few. A stop you're probably familiar with as a stop loss. Let's say you buy a stock at 10, you're willing to risk 20%. You put a stop loss to sell at 8. If the stock falls to 8 or lower, you in turn sell. And if the stop loss becomes a market order after the stop level is triggered. So if the stock opens at 7 in that example and your stop loss is at 8, you'll be filled at 7 or less. So that's the downside of a stop loss. Now a stop limit corrects for that and it becomes a limit order after the stop level is triggered. So you could do a stop loss order with a limit qualifier at 8, meaning it will be filled at 8 or better. Of course, it may not be filled. What some investors may not know is you can use these stops and stop limits to buy as well as sell. And let's look at an example of that. So we have a call trading at 350, bid 345, ask 355. Market order to buy, you're probably going to pay 355. Market order to sell, you're probably going to receive 345. Remember, there's no free lunch. So if you were to instantly buy and sell, you're going to probably lose a few cents. You could place a limit order to buy just a few cents under the market price. That can improve your profitability or decrease losses on the trade by a few cents. But again, over the course of an investing career, over the course of your investing lifetime, these order types can add hundreds and thousands of dollars to your returns. Now, let's say you were putting a stop loss on this option. You could put in a stop loss at 3. It could end up being filled at 290 or lower. You could also use a stop buy. So if you were to use a stop buy, you could say, I want to buy if this continues higher. I only want to buy at 375 or more. And the reason for that is you're trying to trade the trend. You only want to buy if it goes up. So the stop buy increases the probability of doing that. You can also use a stop limit buy, and that has the same benefits of a limit order in that it avoids significant adverse fills. So we may not think of it very often, but the stop loss is there if the trend reverses. The stop buy can be placed above the current market price, and it's only filled if the trend continues. It avoids buying right as prices are reversing. And again, that's the probability over a number of trades. On any given trade, anything can happen, but we're looking at probabilities of frequent trading. Now, buying on stop limit orders, you set the stop above the market price. You're only buying if the trend is in your favor at that point. And think about how powerfully important that could be. Let's say you're looking at an option and it just doesn't move. Well, if it doesn't reach your stop level, you avoid tying up that capital in a trade that's not going anywhere. The limit order avoids overpaying. It prevents the market maker from taking advantage of you. And these combine as powerful benefits, okay? If you're using a stop to enter your trade, you're probably going to increase the win rate on your trades because let's say you have a buy order and the market just unexpectedly opens lower. You're not going to get filled. You're going to avoid that losing trade simply by the way you entered your order. Now, a couple cautions here. Stops and limits for exiting trades can be problematic. When you want to get out of a trade, it's best to just get out. Use the market order. In liquid positions, trading near the open, slippage, the difference between the market price and what you receive, is going to be small. So if you're trading an active option like DEA on the Dow, you don't really need to worry. The order entry, you're trying to increase your percentages a little bit by using orders, types of order limits that will keep you in the right type of the trade. Now, the risk of a limit order is not being filled. So if you were right in wanting to sell, the position's just going to lose value. And you don't want to do that. So that's why we want to avoid the limits on the exits for the most part. If you put in a limit, you have to watch it on the exit to make sure it does get filled. If you have any questions, feel free to contact me on social media, but I do hope you find order entry types to be extremely useful in your trading. Thank you.